As a quick disclaimer, this webinar is not investment advice, so this is purely for information. Please, I do not take responsibility for losses incurred by the viewers. So please do your own research before doing anything. So thank you again for joining tonight. For those of you who will be watching later on YouTube, thank you as well for joining. So quickly for the new viewers, my background, I started to work in the industry in 2000. I started as a cash equity trader in Paris, working for an asset manager. Then I moved to London in 2004. I worked first for an hedge fund called Griffin Capital Management. I worked there for 4 years on the long only product and on the long short product, where we were managing between depending which part of the Europe you were looking at, between $500 million to $3 billion. Both on the long only and the long short. Then in 2009, I joined Infinity Capital Market as a prop trader. So an absolute return mandate, looking at different asset classes, mostly stocks. I worked there from 2009 to 2018. I did some mentoring for another trading education company that I left in 2017. And in 2018, I launched a 4x4 video series that was in 2019. And I'm doing as well some mentoring. And I've been restarting at Infinity 12 months ago. So this is for my background. So today, what we're going to be covering is obviously situation across asset classes, as usual, looking at the 4 asset classes. That will be stocks, credit, commodities, and FX. We're going to be talking a lot about bonds because really the bond market has been moving quite a lot today on the CPI. So this is the second point that we're going to be covering. This is the US inflation. So CPI print today at 40 years high. If you look on a year-on-year basis, so quite impressive. Then we're going to be looking at the earnings season and what has been the trading strategy that has been working during this earnings season. Then we're going to be looking more into the bond market to try to see quickly if there is a risk of contagion to the rest of the economy. So today we had the CPI, the print year on year was above the 7.5% expected. The bonds from the overnight to the 30 years, the whole yield curve moved quite a lot. So quite a massive sell-off in bonds. The US 10 years is above 2%. The US 2 years is at above 1.5%, moved by 15 bips. So now as we're going to be talking today, there is a clear chance that the Fed might be doing 50 bips rate hike in March. And in the meantime, there are many question marks on why the Fed is still doing QE. If the economy, or if at least the inflation is so strong, and the economy seems to be okay, especially with the world reopening, there is absolutely no case of the Fed doing QE. So will that be possible for the Fed to stop QE before March? Really, I think now everything is on the table from the 50 bips in March. But clearly, in terms of catalyst, as we are in the middle of the earnings season, this is always the same. It's about earnings. But clearly, what is most important now is when the Fed speakers are going to be saying something, looking into coming into the Fed meeting that we're going to have next month, which is going to be very important. We get the OPEX, the options expiring next week. We're going to have a lot of rebalancing for these months with the moves that we had. So if you think about the general 60-40 portfolio, which is 60% bonds and 40% stocks, in the 60% bonds, there is absolutely carnage. So on all of this, there are question marks, as we're going to be talking during technical analysis, price action, macro. Clearly, the print is really high. We have been discussing for more than 9 months that this inflation was not transitory and that the Fed was really slow to react. So on one hand, you can argue that they saved the economy by putting a 4 trillion of stimulus when everything stopped. But in the meantime, if you put 4 trillion in the economy, that is not unexpected to have now inflation going higher. So in terms of risky assets, if you think about all those balance sheets that will be shrinking in the future, and we are talking not only the Fed, but probably the ECB as well. That means that the risk on bidding the risky assets is probably not a good idea. So what we had so far on the year to date is we had the sell-off in January. We had these nice bounce from the lows, almost 300 points on the S&P. So we are halfway from the sell-off, between the sell-off and the highs. So the sell-off went to 4,200. The highs were at 4,800. So we are right in the middle. I think the risk reward now is not that great, one way or the other. I got a tendency now to think that the market should go lower on this risk off and this balance sheet shrinking. I don't think this earnings season has been that great on top of it. So again, as a trader, as a portfolio manager, you're always thinking about the risk reward. Now you are in the middle of this range that we had over the last 6 months, and you can see the strong ping pong between the highs and the lows, or the swings that we have on an intraday basis. So sometimes it's if you're actively trading, sometimes it works, sometimes it doesn't. Today for me was not a great day, but I had so far an okay year. But in terms of portfolio construction, what I've been experiencing recently, and actually today, if I look at my portfolio, this is probably the smallest gross exposure that I have in quite a long time, because I don't have real visibility, and I think the risk reward is pretty bad. So again, this is my choice. That doesn't mean that you have to do it. I'm just, sharing my risk reward view. Quickly talking about the asset performances. So that's very similar to what we had a couple of weeks ago. We had a bounce since then, and the question was like, was the bounce that we had on the Monday good enough? So we carry on another 200 points, and I'm talking S&P. I still want to believe that we need to retest those lows. There is no real catalyst for things to go much higher. So you have, and those are the numbers that were taken like a couple of hours ago, the S&P down 4 to 5% here, Nasdaq really underperforming, down 8% on the year. So anything that is developed market has been struggling. You can see that Europe is outperforming US so far. So we'll see if there is going to be some contagion into Europe. Emerging market have been doing better than developed market. In terms of currencies, this is this part here. The dollar has been weakening. So if you remember my last 4-6 webinars, I've been saying over and over that despite yields going higher, for the US yield going higher, that was the case almost everywhere. So I think the dollar is still weakening a bit furthermore. So I'm bullish the euro. I'm bullish. So overall, I'm bearish the dollar, not structurally, but I think in terms of moves, they're probably another 2 to 5% move. WTI really the big winner of the year. So if you're on Twitter, everyone is long WTI, everyone is long inflation stocks, which is quite funny. because you have all those retail traders telling you or want to believe that, they are up, 20, 50, 100% on WTI and all those things. We know it works. If the market is down 5 to 10%, that means 90% of the retail traders will be down. So WTI has been really strong. We're going to see discuss a bit about the technical analysis with WTI, but on the week to date, I'm not even sure this is worth doing it these days, because from every 2 hours we are talking 80 points swings on the S&P. So now the S&P is at 45.12. It was at 45.80 3 hours ago, before a bullet came on the tape and said, I want to do 50 bips rate hike. But what is interesting is, for the crypto people, Bitcoin is up 20, is above the 40,000 again. So in terms of, there are some pockets of risk on that are working, but I will more interestingly going into the next slide, which is looking at the 11 sectors of the S&P, and more importantly on the left-hand side with the year-to-date performances. So energy, similar to WTI again, same picture, up 25%. The financials, so this is the same as we discussed over and over. When yields are going up, when bonds are selling off, when and that's true for the US, that's true for Europe. Financials banks are doing very well. So if you look at the European banks, most of them are making new highs. So I'm talking at least recent highs. Deutsche Bank, BNP. Even the insurers are doing pretty well. So financials are really outperforming the market, which makes complete sense. And on the other end of the spectrum, you get the sectors that could be suffering from higher yields, real estate, utilities, which are underperforming the market, and telco as well. Why? Because telcos do have a lot of leverage in their balance sheet. So if you look at a company, I know when we all start by looking at the market cap of the company, which is, number of shares times the last. But in reality, we need to be looking at the enterprise value, which takes into consideration the debt, the liabilities of a company. So this is much more important. And when your company is quite leveraged, that means when the cost of money is going higher, that means by definition, you're going to probably be making less money. So sectors like utilities, real estate are underperforming or could be struggling in such an environment. Next slide. And this one is really important. This is the bond part. So here we are looking at the US 10 years, the UK gilt, the German Bund, and the Italian BTPs. And we look at the year to date and week to date. So this is the change in bips. So 100 bips equal 1%. So year to date, the US 10 years went up by 50 bips. In other words, it went from 1.5% to 2%. And on the week to date, it's up 20 bips or 18 bips, which is quite a lot. But as you can see, it's not only in the US, it's more or less everywhere from the US to Italy. And here you can see that Italy is underperforming the proxy in Europe, which is the Bund. Why? Because there are some tensions in the credit spreads. So here, really, there are some question marks if the sell-off in bonds and could lead into some not panic, but some stress into the bond market. Here we are talking about sovereigns, but as well that could be into the corporate world. So really, this is the thing as an equity trader. People are always asking me, Greg, what are you looking? The thing is, as an equity trader, where 80% of your exposure is going to be through stocks, you always try to identify what are the catalysts. And obviously, these days, everyone is looking at the same thing, which is the bond market. And the bond market is where we should keep our eyes on. The VIX, so the implied volatility, which is at right now at 23.4. So you can see as well that the swings make make all the assets, even if the VIX is not an asset, moving. So we are 23.5%, which is historically higher than the average. We went recently up to almost 40%. In terms of top winners and losers, again, this is very similar to what we do on every single week, which is based on these days the earnings season. I would like to move now into technical analysis. I was just checking before the call. So AFRM, Arfam Holdings, just came with the numbers before. And as you can see, the swing, the intraday swing, we go from 50. So we went from 83 to 50. So we are talking a $30 move on an $80 stock. So that makes 30 to 40% move intraday. That is quite crazy. Obviously, here this is quite of a special stock, and not all the stocks will be moving. But you've seen as well with names like Amazon, Facebook, and really the outliers moves that we had recently. So this is something that we're going to be talking in terms of strategy. I would like to start with the S&P futures. So the S&P futures, let me call it down here a bit. So as I just said before, we are trading between these 4,200 and the highs of the 4,800. So that gives you a 600 points. We had this big bounce just after the OPEX on the Monday, as you remember. So we had really the lows on the Monday. Then we bounce. Technically, you know, this 45.80 that we reached before. If you look at the S&P, this is an important level for the 200 moving average. And there is, you know, between 48.80, sorry, and 4,700, there is not much. So a couple of hours ago, it felt like, you know, it was a bit squeezy. Now it feels like price action is coming down. So, in other words, if you ask me, I don't have much of a view. I have a bias now. I think the market will go lower. Okay, I want to believe again that we're going to be retesting the lows, but it's a very aggressive and very volatile market. So to me, what works well these days is not to have too much gross exposure. So for the S&P, I don't see much. In terms of technical analysis, I really do. Sorry, let's move into the NQ, the Nasdaq key up. So Nasdaq, the range has been broken. So at least this one is clear. The range that started last year is broken. We are now trading below the 200 moving averages. Feels like the move is down. So if the Nasdaq is down, and as well if the Russell 2000 futures. So Russell today was very interesting. I don't know if you traded it. So the 2100, 2110 is now resistance. So you know what you try to do is if you do some futures on indexes and they are. You can have different, so you don't have to trade always the S&P. You can trade obviously the Nasdaq. You can trade as well the Russell. But what you try to find is some levels. So this one is telling you that as long as you trade below the 2100, feels like we at least are trading sideways to lower. So we tested it. Now we are down 50 points from the high. So I will be putting some alerts. I will be checking those ones. Again, in terms of catalysts, you always try to find what is driving the market because everyone is trying these days to find good levels. As long as we stay below this 2100, I don't see the market going much higher. Quickly, in terms of the potential contagion of the credit market. So HYG, which stands for the ETF for high yield, has seen some selling pressure since the expiry. What is interesting is if you look at the option chain of the HYG, you will see that there is a lot of gamma negative, short gamma, and you will see that there is a lot of positioning on the downside. So what the flows are telling me is people are now, some investors are now forecasting or expecting some pressure in the high yield market. And if you think about it, it makes complete sense. Okay, if you high yield is mostly about if the cost of money is going higher, that is an issue, and if the economy as well is slowing, the risk of defaults will go higher. So if you think about what has been happening over the last 5 years, very true in Europe. We have been living in a world where yields were negative or they were very low in the US. So that means you had, if you were running a zombie company and you were not making any money, you were not paying any fees, so the cost of money was close to zero. With the change with yields now going back into the 2%, and you could see a spread into the high yield. So looking at high yield, same with the muni, where we've seen quite of a strong sell since the start of the year. So those are the things. Even if you, in terms of price, you know, the 2 to 3% of those bond moves are absolutely ridiculous versus, you know, any stock they'll be talking. That is telling you that there are risk of contagion into the credit market. One that I like to be monitoring, which is EEM, discussed again. It is still in this range. I'm waiting for a move that should come. That's going to come. So again, this is the things that you want to have, putting some alerts. JP Morgan that we discussed during the previous session. So it bounced on the support at 141, now at around the 156. But actually, if you think about the yields going higher, the way they have been, JP Morgan has been struggling, and they have been struggling for a right reason, is because the earnings were not that great. Another one that I'm checking as a market leader, which is Exxon. So Exxon that did the move that broke this important level at 66, then one go to 81, 82. So very similar to XLE. So that will be the names that will be checking. And finally, just for one that has been doing pretty well today, it's DDOG. So DDOG, something that I've been trading, bonds nicely on the support. So what I find very, very interesting these days is if you look at the chart and say the stock, let's say the stock is at 100 and you see a support at 80, normally you will say, okay, this stock is going to be taking 3 months to go. And literally, when there is a big move, you know that this move is going to be done in 1 day or 2 days. So I've been trading a German stock today, where I was expecting the stock was open at 62. I knew it will go to 50, and actually it went up to 46. So literally think that these days it's almost like the timeline, instead of being into 2 months, is like 2 days. So it's going very quickly. So play as if it's going to be the worst case scenario. So put aside what you had before, where first the market is always going higher, because it's not true anymore. The market is not going higher, is not always going higher. Forget about no volatility, because there is much more swings, and forget about, you know, it's going to be taking long time for something to reach, especially on the downside. We have seen that with Amazon, we have seen that with Facebook, we have seen that with Peloton, we have seen that with Twitter, we have seen all the names, you can all mention them. It's, you know, you look at a chart a month ago, you say, oh no, there's no chance it's going to go down or up by X%, and 2 days later it's going. So think that really think about the worst case scenario when the let's say those ATR, those moves are just going through the roof, the volatility is going through the roof. That means on the other hand, you should reduce your size. Okay, so if normally you are doing 100 and the volatility is at 10%. When the volatility goes to 20%, you need to reduce your position by half. So that means you do 50, because 50 times 0.2 is going to be your 10 as before. Okay. Another one that I want to jump on is the crude oil. So crude oil, this is the chart that I'm looking, and I'm going to be talking regular. So regular. So the trend that we have since March. So we get this first point, second point, third point, fourth point. So the trend, don't get me wrong, the trend is up. Okay, but there are some resistance. So the resistance was 93.14, I think, on last Friday, because I was trading it. So the trend is as long as you go into the stop, if you're long, I think this is the time to reduce. If you're looking for some short entry, this is the one to go. Tight stop loss, because I think, as we discussed before, that there is potential short squeeze into WTI. But technically, those ones work pretty well. 2 years, 10 years. I'm not going to give you the chart, but you also, yes. Let's do a bit of chart live. So that's the 2 years. That's the US 2 years today. So the US 2 years went from 134 to 160, 1.6%. So if you look at the chart and you put into perspective, we're back to pre-crisis level. So that is not that shocking, but actually the move that we have year to date, we are up 70 bips or 80 bips. So we went from literally 75 bips to 1.6% now. So that means the cost of financing for everyone is going higher. When the cost of financing of short dated bonds overnight to 2 years is going up that much, literally, again, you cannot be running dodgy businesses or businesses where you need a lot of financing, even on a short-term basis. If you need 1 billion and it costs you, like it cost you, let's say a month ago, 60 bips, and now it costs you 1.6%, that is a huge difference. So 2 years at 1.6. Let me give you the 10. So the 10 years at 2.03 now. A couple of weeks ago, I told you, I think if I remember correctly, that we will be seeing in the next month or two the headlines of the 10 years reaching 2%. And here we go, we are at 2%. Not as I'm a genius, it was pretty obvious that inflation was high and we had to go to the 2%. That was an easy call. And finally, I want to finish with the euro dollar. The chart is still the same. We bounce on the support. So this one is pretty clean. Again, having your fundamental analysis, your macro analysis, and obviously backing your analysis with price action technical analysis is the way to do it. If there is a mismatch between the two, you might have something wrong. So let's go back into this up. I think there are some questions. Ellis, for bonds, if we want to go short, you can use TLT. Go on ETF.com, Ellis. You go on ETF.com, and there will be tons of bonds that you can find, and from municipalities to sovereign to anything. And you try to find the liquid ones. You can do 20 years, you can do 30 years, you can do inflation. So literally for retail, there are many bonds that you can be playing with. US inflation. So today, ta-da, CPI since 1948. So this is the chart. This is the move. So we are at 7.5%. So headline number is at 40 years high. So you imagine the newspapers tomorrow in the US. Or actually already no one is reading newspapers anymore. So I'm a bit old school, but watching TV, let's say Twitter, or those things, those are the headlines. And we know that that the politicians, that the Biden administration has been concerned about it because it's way too high. Meaning, in other words, that the Fed will have to do something and be proactive. So CPI food, CPI energy, and core CPI. So the most important one is the core CPI. This one, so at 6%. So the core CPI, the Fed is mostly looking at the core PCE, but core CPI is, let's say, very close to that. So normally, anything that is above 2%, the Fed is a bit on the edge. The Fed has been saying that they're going to be running the inflation a bit more hot than usual. And 4%, you know, we had 4%, 5%, and now we are at 6%. So way, way above. There is a question from Euro. How can we play WTI? So there is one ETF, which is a USO, but that is not a good one because, you know, it's not a good replication of WTI. If you get an account that is, let's say, good enough, you don't have necessarily to do the big futures. You can do the micro futures. So the micro futures, you know, one position will be roughly $9,000 position. So you can do that. You don't need to do the big one. If you are smaller than that, you can do some other ETFs, but except USO, which I don't like. I don't know which one you can be doing. So US inflation. So this is the 10 years, okay, that we just discussed before. So here, this is the news. CPI. So this is UK time. Sorry, because I'm living in the UK. UK time. What happened? The news comes out and US 10 years goes boom. Okay, so we go up by 10 bips. This is for the 10 years. Now let's do the same. If I manage to do it, we do the same for the 2 years. 2 years goes bam. Here we are going up by 15 bips. So if the 10 years is going up by 10 bips and the 2 years is going up by 15 bips, that means that there is a flattening of the yield curve. Okay, so what is interesting is if you look across the yield curve, so yield curve being from 0 to 30 years, so that is the cost of money from 30 to 30 years, everything is starting to flatten. As you've done your job, your work, and you've been building a portfolio and interested in markets, you know that when there is inversion in the yield curve, normally this is the sign of soon recession coming. Okay, so we are talking generally between 12 to 18 months. For the time being, we mostly have a flattening of the yield curve, which means on one hand, as we've been discussing over the last 6 to 9 months, is inflation is going higher, meaning yields are going higher, bonds are selling off. And on the other hand, it's not as if we're expecting a crazy strong economy in the US in 2023, but actually quite high inflation with not very hot economy. So everything is flattening. So when everything is flattening and you get inflation, that is potentially your worst case scenario. So S&P now at 44.92. So we are back at 2 days ago, a year ago level. So US inflation. So I updated this spreadsheet slide just before the call. So euro dollar is a good way of pricing when the Fed will be active hiking rate in that case. So if we look at the March 2022, which is the next meeting, we have 47 bips differential. So the market participants are now pricing, let's say, 90% chance that the Fed is going to be doing a 50 bips rate hike. So a month ago, everyone was telling you no. A couple of weeks ago, everyone was telling you no. And now, tomorrow, everyone is going to tell you, and you can make sure that tomorrow you're going to have this headline saying Goldman Sachs is now pricing a 50 bips rate hike in March. Okay. That is the beauty of this market. This is why you get so many bullshitter. 50 bips rate hike for March. What else is priced? For June, before June, we should have 1%, 100 bips, meaning 4 times 25 bips hike before June. Okay, so that is quite something. Then if you look at December 2022, so mean End of this year, we got 1.7%, which is almost 7 times 25 bips. Okay, so what about the terminal rate, which is the end of the cycle of hiking rates? We are talking plus 211 points. Okay, so we are at 0 or 0.08 for the Fed fund rates. If you add 211, that makes 220, which means, you know, we are close to this inflation between normal inflation target, which should be at 2 or 2.5%. But what it tells you is over the last month, we had a huge move on the Fed expectation. So on one hand, you can argue that actually the market is only at 5-6% from the highs and have quite nicely digested the idea of the Fed hiking rates. On the other hand, I think that tells you that the market is really more and more reacting at the last minute. Okay, so it's true for the bond market, and it's true for the equity market. So we wait, and then we move. So that's true for the bonds. So today we are moving 15 bips, 20 bips across the yield curve. And when the equity market will be pricing that actually, oh, the Fed is going to be doing 50 bips in March, then it has to be doing another 50 bips in before June. Plus, we're going to have quantitative tightening. That is a lot to swallow. So in terms of risk, if you believe a bit that these tons of billions, trillions put into the financial system help the risk appetite and risky assets to go higher. On the other hand, when you withdraw money from the market, from the economy, when you take money from this pipeline, that should not help the risky assets. So my view, and I might be wrong, is in terms of exposure, reduce your exposure and potentially, you know, look on the way down, because, you know, if really they withdraw money of the, and they, when I say they, I hate when we say they, but when the central bankers will be withdrawing money, that will be having effect. And you can see that the move is going to be quite strong. And if you hike the rates by 100 bips in 6 months, that is pretty significant. Really, the question mark, as I said when I started the call, is why is the Fed still doing quantitative easing in Feb and March? Could we see a headline before the next Fed meeting by saying, actually, we are reducing the quantitative easing? I think this is possible because inflation at 7.5% will be making the headlines. You can make sure that the Biden administration will be calling the Fed, will be calling Powell and say, look, Jude, you need to do something. Alice, you got a question on how do you read the euro dollar? I strongly advise you to be watching the other webinars that will be explained. It's not that complicated. Next slide, earnings season. And because, you know, what matters is really the earnings season as well. So we've done a lot about bonds. We're going to be discussing again later about the bonds. But again, we are in the middle of the earnings season. So earnings are very important. That is very true that overall the market is driven by both the earnings season and what the bond market is telling us. When you have such a news like the CPI that is going higher than the expectation, on expectation already pretty high, that is not helping the equity market. So what about the earnings season? So far, if we look at the S&P, almost 3/5 of the companies released their earnings. And out of those 3/5, 68% beat the sales versus 67%. So that is not that bad. And on the earnings, 76% versus 82%. So 2 weeks ago, we started to see that phenomenon, which is sales are almost in line in terms of beating the expectation, but earnings are not that good. Which makes sense if you think of something that are raised over the last 3 months during those webinars, during the mentoring sessions, is we know that the operating margins of the companies are pretty high, but we know that there is inflation, and we know that there is wages going higher. When inflation and wages are hitting companies at the same time, that is hitting the earnings. The only companies that are outperforming in this market is the companies that are able to pass those wages higher, or those inflation into the pricing of their product. So in other words, they are price maker. If you are a price maker and you are in a position to increase the prices of your product in that earnings season, you can see that they are massively outperforming the companies that are not able to pass on those wages or this inflation. In other words, that they are price taker. So if we go into the next slide, so this is something that I like really much, which is done from Refinitiv. You can go on the Refinitiv website and subscribe to their weekly newsletter. The most important part is this part at the bottom, which we're going to go up, which we're going to go into the next slide, which is about discussing what has been happening, the trend that has been happening in terms of S&P 500 surprise in terms of percentage. So here, this is a long time ago, that was 2 years ago, and here this is for the last quarter. So the trend has been, so this is the one to look at. You see that before COVID, we knew that the surprises were coming down. So the market before COVID, there was already some fear that, you know, earnings were coming down, that the margins were probably peaking. After that, companies started to beat expectations like massively. Okay, so 1, 2, 3, 4, 5 to 6 quarters. This is the one we had big beat. What is interesting from this quarter is the surprise from the S&P companies are not as important as before. So in other words, you know, when you look at the market and you say, oh, why is the market reacting like? There is always a reason. I mean, today the reason is CPI. The market is CPI bonds. It's obviously important, but in the long run, there is a strong correlation between the level of the S&P and the level of the earnings. There is less S&P surprise. 5.2% is really below the trend that we had over the last 6 quarters. Remember, over the last 6 quarters, there was always a spike during the earnings season, and we were always like, wow, the market is up another 15%, then another 15%, because company literally hammered the expectation. Today, at least so far for these earnings, when you have, you know, 60% of the companies that already released, that is not the true. That is not true. So if you think, and if you believe in terms of earnings momentum from one quarter to another, if you think about what we call the earnings drift, meaning, you know, when a stock does better on the earnings, it drifts higher. When a stock, you know, when a company comes with bad earnings, it drifts lower. There is a chance that, you know, this momentum will last at least until the next quarter. So expect another 3 quarters of lower expectation. This one is from Bespoke Invest, so that on Twitter. And what we should be looking is not only the trend that is going lower here, but more importantly, this is this part that I found interesting, and why the market before today, at least for this week, was doing a bit better, is stocks, companies that came recently with, at least for this week, and it's very short term, but that's to explain to you as well what is the price action, and that the companies were beating a bit more the expectation here, and the effect that it has is the stocks on the day did pretty well. So stock did pretty well. Why? Because the earnings were a bit better, at least for the last 3 to 5 days. But overall, if you look at the globality of this earnings season, we are below the trend that we have over the last 4 to 5 earnings season. And really the beats, we are beating, but by a very small margin. So again, earnings momentum is not great. Next one. What has been the strategy that has been working very well during this earnings season? So this one is from Goldman Sachs, and it's explaining to you buying a straddle. So we're going to be talking later about, you know, straddle. But what happens is, so this is this part is here. So when you buy a straddle, you are expecting to be making money when the realized volatility is going to be much higher than the implied volatility. So in other words, to make it a bit easier, if the market is expecting one company, let's say we're going to take the example, I think we're going to take the example later, but one company that is expected to be moving by 10%. Okay, so the stock is at 100 and we expect the company to be moving by 10%. If you buy some volatility and the stock moves by 20% on the day, you'll be making money. Most of the time, what happens, if you look at that chart, and that is from 1996, very often when you long straddle, you'll be losing money. Okay, so you'll be losing money all the cases that are below this black line, because by definition, you know, when you go into the earnings season, when you buy protection, and this is the same with your house, you'll be overpaying the premium. So implied volatility most of the time will be higher than the realized volatility. So that will be like you buy protection for your house not to burn for 20 years, and it never happens. And for 20 years, you're pissing away the premium. But what has been happening this year, or not this year, for this quarter, this earnings season, is actually if you've been buying protection, you'll be making a fortune. And this is why the strategy, which is, you know, buying a straddle. So what is buying a straddle? And I try to do a bit of education here, similar to the 4x4. So 44.80 on the S&P now. It's a bit ugly now. So buying this, what is buying a straddle? So we are buying a call option A and a put option B on the same underlying asset with the same expiry and the same strike price. So the idea of this trade is non-directional strategy, where the bet is on the rise of the volatility, as I said. So not the best strategy normally for retail traders, because as we are paying a big premium by being long and call the put, really for this strategy to work, literally we need a massive move. And if we look over history, that is a strategy that barely works. But as we're going to see for this season, it has been working pretty well. So what is the maximum loss? The maximum loss of the strategy, which is a good thing, is limited, because you long the premium of the call and you long the premium of the put. You get an unlimited profit because, you know, if the stock goes through the roof with your call, you long the call, you can be unlimited. And the break even is strike A plus prime. So let's look at the example. I took the example of Twitter. Did that, I think, yesterday or a couple of days ago. Looking at when the stock was at 36.15. And I look at the money call. Okay, at the money call and put to be buying the straddle. So the call was, I did the mid between the 3 and 3.1. So buying the 36 call cost $3.05. Buying the 36 put cost me $2.92. So what is the total cost of buying the straddle? Is $2.92 plus $3.05, which makes $5.97. So in other words, to be break even, I need the stock either to go lower than 36 minus 597, which is 30.03, or I need the stock to go higher than 36 plus 597, 41.97. So your break even is very large. And if you had the idea of making a 3-to-1, literally you need Twitter to be down to 12.12 or Twitter to be up to $60. So roughly you need a 66% move. So as you can see, you know, normally most of the time you implied, it's going to be hard with the implied volatility, which is here, for the realized volatility to be much higher than the implied volatility. But what has been happening during this earnings season, you can take the example of Facebook, you can take the example of Snap, you can take the example of whatever, not whatever, but many cases, the stock has been moving much more than what was priced for by the implied volatility. So the straddle, those are the strategies that have been working pretty well. You can see probably as well that there are many option traders these days that are as well looking at the straddle on a daily basis. So you could be like 3 hours ago, if you are looking at the, which one did I do? If you are looking at the 45.70 straddle weekly, it was trading at $45. $45, meaning that you had a 45.25 break even. Okay, so those are the things that should be looking these days when you think that the realized volatility is actually, that the implied volatility, the cost of implied volatility should be higher, or it's cheap, and actually you think that the move is going to be much more than the implied volatility. Okay, I hope it makes sense. This is really a strategy that has been working very well for this earnings season. Normally it doesn't, but in terms of pricing, I find it always interesting when you have a position of a stock thinking, okay, by how much the market is expecting the stock to be moving. So if we look at Twitter a couple of days ago, the market was expected the stock to be moving by roughly $6 on the day, okay, versus a stock that is on at 36. So we are talking 17–18%, whereas the stock barely moved today. And similarly, if you start the week, you can be looking on the Monday, you can be looking at the Friday's option at the money and thinking, okay, what is the price of a straddle now for expiring on Friday? And do I think that the market is going to be moving more or less than this? If you long the straddle, you get limited downside. If you go short an option, you get unlimited downside. So the rule number one, as a retail trader and as a trader, try to avoid being short options. Okay, only professionals should do that, and even professionals sometimes are struggling. But be very, very cautious when you get people, educators that are telling you, oh, you should go short this option, you should go short the straddle, you should go extra. Because when it goes against you, you get unlimited downside. So here, this is the payoff of the straddle that we look for Twitter. So you get the two break even around 30. This is the one around 30 and 40. If it goes lower than the 30, you are starting to be making money. And if it goes higher, you are making money. So you got this space between 30 and 40, which is quite a big range where you lose money. Okay, so you are negative, and here and there you're positive. So what has been happening? Again, I'm repeating myself. Market has been moving much more than what the implied volatility was pricing. Okay, I hope it helps. I think this is an interesting one, looking at this strategy. Finally, coming back into the bond market, because this is mostly about the bond market. So here I'm using from the St. Louis thread, trying to, so there are a lot of talks, not a lot of talks, but on Twitter, on FinTwit about, contagion, potential contagion in the credit market. If the credit market, if the whole yield curve is moving, that is for sure that the high yield is going to be moving. So if you look at the perspective, you can see if you look over the last 5 years, the high yield is quite at the low level. Why? Because all the yields were at historically at very low levels. So mechanically, it is going higher. And as you can see, the move recently is very much the yield move. The question is, are we going to start to see some contagion in the credit market? So the contagion in the credit market could be sovereign. So you remember the contagion when we had Italy, when we had Greece a few years ago, and when the spread between, let's say, the Bund, and which is the German 10 years, and the Italian 10 years, which is the BTPs, started to increase, then you can have some contagion. That's the same here. We try to see if we start to have some contagion. That is important. Here I'm taking the German 10 years. As we see here, for 2.5 years, the German 10 years was trading negative, meaning that even if the German economy is fantastic and they only have good companies, if you were running a dodgy company in Germany, that was absolutely painless, right? Because you could have been running a zombie company. The cost of money was 0 or negative. Whereas these days, even if it's very low, okay, it's still very low, the cost has been going higher. And that means if the cost of the proxy of the no cost has been going higher, it is true across all the bonds. So that means if you are running a company and you start to see some contagion, that means the spread between the high quality, like the 10 years, and the high yield, or even the better rated, will be going higher. So as we are trying to find IDs, and you always come to me and say, look, Greg, what are the catalysts that you'll be looking for? These days, it's pretty obvious that it's all about the credit market. Okay, so you need to think, okay, I need to be reading about the credit spreads. What is the credit spread? What is the difference between the different notes of a company? What is a AAA? What is a BB? And where is the BB trading versus, let's say, a AAA, even if you don't have much? And what is the impact of refinancing? If you have been a company that has, let's say, 10 billion debt on your balance sheet, and in the next 12 months, you need to refinance, let's say, 2 billion of your bond with the existing conditions. So first, the condition of the credit market, that the credit market is offering widespread. So you're going to be paying more. And as well, that the cost of money is going higher. So suddenly, all your models that you can be doing and your discounted cash flow and the cost of financing, everything is going higher. So you get the impact of refinancing. So make sure each time you do some fundamental analysis, you do what we look at the debt distribution. Okay, debt distribution is when is the debt of the company maturing, and when is the risk of refinancing, and what is the price, what is the cost of the existing financing. So what you need to do is you need to be checking the existing leverage. And here, look at enterprise value instead of looking at market cap. I remember some educators saying, oh, I'm long, I think it was G, it was some years ago. I want to be long G because, G is, I think it was, I don't know, 50 billion market cap. And the stock went from 15 to 5. And they forgot to mention, or not they mentioned, they didn't even know that it didn't really matter because G had 100 billion of debt. So always look at the enterprise value. What is the potential contagion to credit? Okay, who could be the most affected? Here you can be looking at regions as well, because obviously if you are an Italian company and the spread between the BTPs and the German bonds has been widening, the local companies in Italy will be suffering more than the German companies. Why? Because the cost of money is going higher. How are the different single names maturities trading? So what you want to be looking here is if you get doubt about, how the bonds are trading, what you should be doing is finding, you can go on several websites, you can be using Icon, you find some single names that are trading 5 years to 10 years, and you try to find how those bonds have been trading. So I always take the same example, which is, either looking at General Electric. So you'll be looking at the bonds of General Electric in 2018 when they went boom, or you'll be looking at all the oil services in 2015, 2016. So all the oil services like Transocean bonds literally went from 100 to 60 or 40 because everyone was saying the risk is not on the stock is already down the toilet, but what matters is really the bond and how the bonds have been trading. Then you can be looking obviously at different multiples, EV on EBITDA, different multiples in terms of financing, refinancing, cash. So here, probably looking at the 4x4 will help. And really the concept that's going to be key in the next few years, if we continue of shrinking the balance sheet of the central banks, or at least if we start, and if the cost of money is going higher, the zombies companies. So that has effect. And finally, and I've not put in it here, there is another effect that is going to be important, is for private equity. Why is it's important? If you are private equity, what you do when you do a deal, you do 20% equity, let's say 20% or 40% equity, and the rest is in bond. So if the cost of money is going much higher, it's much harder to do the same deals. The cost is much higher, and that means as well the overall prices of those assets are coming down, and they should be coming down. So those are the things that we should be checking. Quickly, what I do, 3 things. I do the trading community. So thank you for those of you that came with some ideas for the webinars, by the way. This is something that I'm going to be pushing, doing new formats of webinars. I got a lot of ideas. If you want to help, feel free. I think this is the idea of the community, trading to helping each other. I try to put content every single day, doing a daily, long IDs, short IDs, risk management. People are more and more, I think, feel more and more confident about putting some content. So let's carry on. Second product that I can offer is the 4x4 video series. So it's based on my 20 years experience, long only, long short, my experience as well working for another education company where I knew people were struggling with many of the concepts. And finally, the mentoring, which is something that I've been doing since 2014. I've done almost, I think, 100 mentees so far. So it's one-on-one session through Zoom, something that I enjoy doing. It's about, going through the process. So we go to the macro analysis, we go to the market analysis, so price action, very similar to what we do today. Then we go first into the quantitative analysis. So we take all our stocks, we do some filtering. Then we do qualitative analysis. So trying to match the numbers with what the company and what we see from the company and the sector and the industry. Then we do price action technical analysis, very much what we do between session 10 and 20 today. Then we do a lot of risk management. So risk management is probably where my mentees are struggling the most, because it's about doing it over and over, and this is not rocket science. It's really looking at the risk reward, putting the strategy. So I like it very much. I think it's great to see people growing. So if you have questions, you can send me an email at greg@duponttrading.com or going into the website. If you like those videos, you put a thumbs up on YouTube, or tell your friend that you like it. If you got some ideas about things that you would like to learn, what you think are missing in the education space, I will be very happy to get it from you. Any question? I'm just trying to go through. If Fed doesn't raise rates by March, do you think the market will sell off hard? The Fed will raise. Before March or in March? Can they do before March? I think the confidence it's the central bankers, the Fed saved the world in March 2020, okay? The downside of saving the world is putting a lot of money and doing as well a fiscal stimulus is we got inflation. Okay, so now that we're in inflation, we can't blame them and say, it can't always be a win-win. So this is the downside of putting a lot of money into the system. What we have now, and I think this is, and I'm on record over the last 4 to 5 months saying, that is complete stupidity to still have quantitative easing. They don't need to be buying bonds. That is absolutely nonsense. Okay, buying bonds when the system is not working, was not working. That was normal to do it. They should have stopped probably in September, October last year. I'm saying 2021. So Can we see some headlines that they could reduce it before next meeting in March? I think a lot of confidence has been lost. That is true for the Fed, that is true for the ECB. So the ECB flip-flop by saying there is no inflation, then there is inflation. As always, ECB will be following the Fed, and that's the same with the Fed. The Fed say, no, there is no inflation, then they say there is inflation. So for me, and I think for market participants, they have been struggling with what the Fed has been saying. And in the meantime, understanding that it was what the role of the Fed, the job of the Fed over the last 2 years has been extremely, extremely hard. What else? I think, do you think the S&P 500 will melt up to 6,000? Are you talking your book, Ellis? Are you very long the market? For the time being, I don't see any melt up. I think what we had is we had years of thinking that the Fed, the central banks are always here, and we didn't have any inflation. Now we have inflation. It's not like, I mean, we are not in the bear market because, you know, we are only 8%, you know, 10% from the all-time highs for the Nasdaq and 5-6 for the S&P. But the price action is really, really bad, and it feels like it's not feel is I think that so far the momentum is on the short, and I think there is a good chance that we at least going to be testing the 4,200 because the Fed tightening, because, you know, earnings season is not great because shitloads of inflation. So for the time being, you know, I don't see a melt up whatsoever. Any other question? Question on where to place your 4x4 program on your resume. Oh, that's a good question. And LinkedIn. I don't know how. I think you should just say, you know, I've done this brilliant education. And you put my name. No, let me think about it. I think you need to have something that is yeah. Send me an email, and I think we should structure that in a very professional way on LinkedIn. Any other question? I'm in a good mood today. 44.95. Even if I lost a bit of money, I'm in a good mood. So, to me, I reduce exposure. I think visibility is very reduced. I don't like the price action. I'm very much more confident than when I go short. And having said that, you know, this market is very vicious. So if you think that you were at the same level a couple of days ago on the S&P, and in between you rallied by 3-4%, don't try to be a superhero when you identify levels. What I try to do, and sometimes I'm a bit annoyed with myself, find the levels before putting position in the middle of nowhere. I think this is really important. If you get, as I said, if you look at a stock at 100 and you see a support at 90, actually, even if the ATR before was only 5%, you know it's going to be moving much quicker. Okay, thank you for those of you who gave me some great idea on the community for the next webinars. I'm still pretty much open for help for the marketing, for the ideas, for a lot of things like this. So if you are following tonight, or if you are following later on YouTube, if you think that you get great idea, you can help me and I can help you. That would be, yes, thank you, Brian, by the way, thank you very much. So talk to you soon. Let's try to do that in a couple of weeks. Again, OPEX expiry in a week time, but that means we're gonna have a lot of volatility still. Thank you very much. Good night, everyone. Bye-bye.